Welcome to the Deep Dive. We are jumping straight into the third quarter 2025 earnings call. It dropped right after the market close on November 5th. And this was one of those classic head scratchers for the market. The numbers that everyone watches, they technically missed, but the stock just took off.
That tension is exactly why we had to get into this one, because if you just read the headlines, the EPS figures, the revenue, you'd expect a sell-off.
A pretty sharp one.
Yeah. Right. But the market just completely ignored the misses. It looked right past them and focused squarely on the future.
On the story.
Exactly. The record operational metrics, this huge shift in cash flow, and the really aggressive strategic narrative they laid out.
So that's our mission today. We're going to cut through all that noise and really analyze three things. First, those historic results that fueled the rally. Second, the big M&A moves that basically doubled their global reach. And finally, the AV plan, the autonomous vehicle strategy they finally put some real meat on. So let's start with those results.
Okay, yeah, let's get the misses out of the way first.
Rip the Band-Aid off.
So GAAP diluted EPS was 11 cents, which is a nice swing from being negative last year.
Okay, that's not bad.
No, but the number the street really watches, the adjusted EPS.
Yeah.
That was 26 cents, and the consensus was 30.
Oof. So a miss. And revenue.
Same story. Came in at $1.69 billion, just shy of the, $1.7 billion they were guiding for.
So if they missed on the two big numbers, how on earth did they convince Wall Street that they were winning?
By showing that the machine is working, the operating leverage is it's fully engaged. It was all about volume and efficiency. Gross bookings hit an all-time record, $4.8 billion. That's up 16% year over year.
And the user numbers, I saw those, they completely back that up. We're talking record engagement. 28.7 million active riders, 18% growth. And they completed, almost 250 million rides.
248.8 million, up 15%. And that kind of volume, that's what guarantees future margin expansion, as long as you can control your costs.
And they did.
Precisely. Adjusted EBITDA, $138.9 million. That's up 29%. But the real story, the inflection point the market cheered, was the cash.
Wait, how big was the cash number?
This is the milestone. For the first time in the company's history, their trailing 12-month free cash flow crossed $1 billion.
$1 billion. Wow.
That isn't just a little margin improvement. That is a fundamental shift in the business. They're not a cash-burning growth story anymore. They're a mature platform that's just printing cash.
You can't ignore that. A shift from cash consumer to cash generator. And the CEO, David Risher, he leaned right into it. He framed Q3 as proof that the comeback strategy is working.
And their forward guidance for Q4, it really backed up that talk. They guided for gross bookings between 5.01 and 5.13 billion.
So accelerating growth.
Accelerating. That's 17 to 20% year over year. The story is clearly momentum heading into 2026.
Okay, but it's not just about Q4. What really seemed to drive the stock were these converging catalysts they laid out for next year. It felt like a whole new playbook.
It is. First up, M&A. They're getting the full year contributions from FREENOW and TBR Global Chauffeuring. That's a huge tailwind.
Then you have the big partnership with United Airlines.
Right.
Linking accounts, earning miles on all rides, not just to the airport. Management really hinted this would drive some serious volume, especially with corporate travelers.
Then the third one, and this could be a game changer for their economics, is regulatory. California insurance reform, SB 371.
Okay, so how massive of a deal is this, really?
Well, according to management, right now, riders in California pay, on average, over $6 per ride just for insurance.
$6?
$6 per ride. It's just baked into the cost because of outdated rules.
That's incredible. I mean, that's just friction for the customer. If they can pass most of that savings on, that could seriously boost demand.
Absolutely. And their final point was about new markets. They said 2/3 of all personal car trips in North America are in what they call underpenetrated markets.
Like college towns and suburbs.
Exactly. Think Bloomington, East Lansing. And get this, 70% of their Q3 rides growth came from those areas. So the addressable market is way bigger than just a few big cities.
Okay, so let's shift and really dive into those expansion moves. The FREENOW acquisition, that feels like a defining moment. It nearly doubled their addressable market overnight.
It's a huge move. Gives them a scaled European platform. 9 countries, over 150 cities.
And they're projecting it will do, what, about €1 billion on the top line in 2026.
That's the number. It's a massive diversification away from just North America.
And complementing that is TBR Global Chauffeuring. This one seems different, more targeted.
It is. This is all about the high-margin premium layer. Corporate travel, high-value airport rides in places like Dubai, Paris, London.
So it's a focus on profit, not just volume.
Exactly. And it's smart timing. Their existing high-value rides grew 50% year over year in Q3. So TBR is basically an accelerator for a segment that's already on fire.
All right, now for the long game. Autonomy. The roadmap they laid out, it felt different. It felt more concrete this time.
I agree. It's sophisticated, and it's all about partnerships instead of trying to build everything themselves.
The Waymo partnership is the core of it.
That's the linchpin, yeah. They're putting in 10 to 15 million in CapEx for a depot in Nashville. But the key here is they're using their subsidiary FlexDrive to manage the fleet.
And FlexDrive is their vehicle leasing arm, so they're experts in keeping cars on the road.
That is the key differentiator. It's all about utilization. Their FlexDrive already gets a 90% availability rate. And the deal is structured so they earn revenue whether the ride comes from their app or the Waymo app. They just want the cars driving.
So they're not competing on who can spend the most building robots. They're competing on who can operate them most efficiently.
Exactly. And that same idea extends to their other planned partnership with Tensor using NVIDIA tech. It sets them up for a hybrid network.
Human drivers, their own robotaxis, maybe third-party fleets, even consumer-owned AVs.
Right. It massively reduces their own capital risk. And they made a really compelling point that AVs actually expand the market. In cities where AVs are already operating, the whole rideshare market is growing faster.
Okay, so this entire package, operational strength, cash flow, a real global and AV strategy. The market just ate it up.
They absolutely did. Despite the EPS miss, the stock jumped 3.4% right after the call. And that just kept going. It ended up rallying about 26% over the next 6 days.
That rally really confirms it. Investors are buying the turnaround. They're buying the pivot to cash, to global scale, and to this, credible shot at autonomy.
And if you look at the stock's performance over, say, the last 3 months, it's up around 58%. It's crushing the broader market. A complete reversal after years of underperformance.
The whole narrative has changed. It's not, can they survive anymore?
No. Now it's, can this focused cash-generating platform sustain profitable growth? And Q3 gave them a very loud yes.
Which brings us, of course, to our final segment.
It does.
And a very quick reminder for everyone listening. This segment is purely for entertainment and discussion. This is absolutely not investment advice. Please consult your own financial professional.
Okay, disclaimer done. The thesis here is all about 2026. We think the market has priced in the basic turnaround story.
But not the full picture.
Exactly. It has not priced in the synergistic operating leverage you get when two massive margin-boosting catalysts hit at the same time. You've got the high margin revenue from the TBR acquisition coming online, just as the huge cost stimulus from the California regulatory win, SB 371, kicks in.
So the trade idea, I'm guessing it's not just buy the stock.
No, after a 58% run that's expensive, you want to use options. You want to bet on a big step change in valuation next year.
Okay, lay it out for us.
We'd suggest a bullish option strategy. Look at selling some near-term out-of-the-money puts. You collect some premium, betting it won't crash in the short term. Then you use that premium to help fund the purchase of long-dated calls, something expiring maybe mid-2026. You're targeting that window when the FREENOW and TBR integrations are fully baked in, and, crucially, when we get the first real data on AV unit economics out of that Nashville partnership. You're betting on that convergence to lift the stock way above its current, $23 range.
An aggressive but strategically targeted pitch. I like it.
Okay, to wrap this deep dive up, the key takeaways are pretty undeniable. First, record cash flow, over $1 billion TTM. Second, they've strategically doubled their addressable market. And third, they have a concrete, differentiated AV roadmap that's all about maximizing utilization. And that leaves the final question for you to think about. When 2026 actually unfolds, which of those big strategic levers is going to be the most significant driver? Will it be the regulatory win in California, SB 371, that slashes costs? Or will it be the operational success of the integrated AV supply in Nashville? Both are huge, but one of them is going to define their year.
And that's the challenge for analysts and investors going forward. Thank you for joining us for this deep dive. We'll talk to you next time.